Hello, everybody. Luke Gromen, FFTT. Hope you are well, having a great week. Thanks for joining me. Thank you for submitting questions, as always. Really enjoy these interactions back and forth. It's great to just kind of stay in the flow of what's going on. And so, thank you. I'm going to jump right in to try to get to as many questions as possible. I'm going to have our show applause here. Our special effects, our little special effects board. I always get a kick out of that. So let's jump right in. First question is from CC. Luke, can you comment on purported physical gold exchanges being financed, built, and paid for by the Chinese, but run by local authorities in India, Saudi Arabia, Brazil, and other places? And if this is true, your views on what that means in the context of your larger global macro view. I've heard reports. I've not seen anything confirmed yet by Eastern or Western media. Uh, I think in terms of what it would mean, it'd be, I think, a super important thing. All of those countries that you list, except for India, are commodity suppliers of China. Um, India, even just today, Bloomberg headline reportedly buying oil from Russia in Chinese yuan. And so this would fit into the model of the internationalization of the yuan, multi-currency energy pricing with net settlement in gold at the central bank level. And it would, everyone always says, oh, I'm not going to trust the Chinese with my gold. Good on you. You probably shouldn't. But if it's a Shanghai gold exchange vault sitting in Saudi Arabia, sitting in India, sitting in Brazil, not a lot of risk there, is there? Chinese aren't going to come get it. It's sitting, and so that's what I think. Ultimately, I think we will see headlines eventually uh, indicating those moves. Haven't seen them yet, and it would all fit into the yuan offshore clearing banks, or the offshore yuan clearing banks that we have seen the Chinese establish per the IMF in the UK, major gold trading hub, in Dubai, major gold trading hub, Singapore, major gold trading hub, and Switzerland, major gold refining hub. Um, and like I said, I think it's ultimately it's very clear to me what they're doing. I don't know why there's really any argument about it anymore. Which is, as the late great Harold Malmgren said in 2019, the Chinese are moving to a gold-based yuan, not gold-backed. They're not tying it to gold. No one's going to tie it to gold. It's gold-based. Gold is serving as the role in the same role that the Treasury bonds served at in the post 1971 dollar system, except face value Treasury bonds can't float, and the supply of Treasury bonds are infinite. And the U.S. needs negative real rates on our Treasury bonds just to keep its fiscal math on the car, or fiscal wheels on the cart. In contrast, gold has no limit on its face value. It is limited in its supply in physical terms, and it reacts really, really well to negative real rates that the West needs just to not default on its debt nominally. So it would ultimately set up a situation where gold goes higher in yuan. That means creditors of China, commodity suppliers of China, have more gold that goes up in yuan. They can, if they want, use that as collateral or sell it, arrive at more yuan, which means they can buy more Chinese goods, which means China buys more commodities from them. It's a virtuous cycle of trade they're setting up. It's so crystal clear to me what's happening here. And the net of it is that gold surpasses treasuries as the number one reserve asset in the world. And that sounded crazy when I started saying it a few years ago, but as we saw the FT report last week, had on our X feed, we're like a month or two away from that happening. So, then you have to ask yourself, if gold is the biggest reserve asset in the world, are we still in the dollar standard? Think about that. From Gail, most happy FFTT subscriber here, very happily. Thank you, Gail. Appreciate your business and thank you for the kind words. What is your take on the odds of a scramble for physical gold and a collapse of the paper gold markets if gold were suddenly revalued? Would a major paper versus physical mismatch cause an additional big leg up in physical price? Possibly. I think it would depend on the situation or the scenario. I think such a mismatch, were it to occur, would also heighten the risk of cash settlement at prior day's close. In other words, hey, gold was at 4,000 on Friday, gold's at 10,000 on Monday. We will pay you. You own an unallocated gold claim. We will pay you $4,000 cash. You go source your own gold, and you have to buy it at 10,000 in the market on Monday. Sorry about your luck. You should have bought physical in the first place. Certain custodians could do that. That would be effectively declaring force majeure. It's not unheard of in extreme situations. And they'd probably, if they had the gold on their books, keep the upside themselves to recap their own books. Which custodians? Don't know. Would any of them do it? Don't know. Maybe none would. Would it happen at all? Don't know. But I think the really important thing to highlight is there's a really easy solution to preempt all of the risk of this, which is just buy gold. Buy gold, physical bullion, and or allocated bullion with a very trusted custodian. And then you don't have to worry about it. Then you can sleep better. From Shiv, if the government, is incentivized to, quote, run it hot, as we've said multiple times, but a number of different recent interviews, and they rack up debt to aid a massive AI infrastructure build out and then devalue the currency, it needs lower inflation, lower rates, lower oil. How do you think oil responds in the next 6 to 18 months? The gold to oil ratio is also high right now. I would modify that just slightly to say that I think running it really hot will bring debt down. All else equal, if they run it really hot, as I think they ultimately will. Look, but to answer your question, I think gold to oil ratio, while high historically, I think it's likely going higher over time. In my opinion, oil over the next few years probably trades in US dollar terms at the highest marginal barrel cost in the world, plus 10% or so, right? So, if the break even on shale is 70, oil probably trades 77 to 63 to 77 on relatively low volatility, and the release valve to any related inflation around running it hot is going to be gold. We're already seeing this. This isn't speculative. Empirically, we're watching this happen, and because it's different than the oil-led inflation and with a fixed gold to oil ratio, basically within a range of the prior 50 years, people aren't seeing. We've gone through a change. The market is playing by new rules. Gold is the release valve now for inflation and for running it hot, not oil. Why? Well, if gold skyrockets, it adds to global demand via Chinese consumers who own a bunch of gold, Indian consumers who own a bunch of gold, Arab consumers who own a bunch of gold. If oil rises sharply from here, it breaks the global economy. You can't have oil spike here with U.S. debt to GDP at 120%. You just can't. You're going to break the treasury market. And as soon as that happens, you go into a debt spiral. Because oil prices spiking leads to real economy inflation and stagflation. It takes away from other parts of the economy. So from both an empirical structure and a strategic reason for it, look, I don't think, I think oil is going to be fine, but I think oil is going to trade at marginal oil barrel cost globally, plus or minus 10%. And, gold's going to be the release valve. From Tim, still bullish on PAVE ETF, long-term infrastructure ETFs. Update on that with some color would be interesting. I am in a word. Infrastructure build out. I mean, you're seeing it, all this AI bubble, the AI bubble, and I'm not opining on whether it is or it isn't. There's certainly signs that I can understand why people are making the case, but in the end, I don't care. I'm not trying to bet on that war. I'm trying to sell picks and shovels to both sides of that war, or trying to sell weapons to both sides of that war. And the the people selling picks and shovels to that are a lot of the companies in the PAVE. It's the electrical infrastructure. And I'm still hearing years of open field running in terms of infrastructure build out, refurbishment, etc. Trump was talking about it earlier today. From Andrew, what do you expect to happen to home prices in the next few years? Will those prices keep inflating, or will higher unemployment rates finally make a noticeable impact? A good question. In my opinion, I think it's going to be a lot more. I think home prices are going to be a lot more local market specific, area specific, type of homes specific. Look, insurance on ocean, near the ocean type stuff, I think it's probably going to keep going up. And if you've got 2 mortgages and an insurance payment and a homeowner association payment in Florida, there's not a lot of room for price appreciation, and you're seeing that in certain parts of Florida. I think property taxes, particularly in traditional higher cost blue areas, property taxes probably gonna have to go up because they're bumping into problems with pensions. If your property taxes go up, the value of your property doesn't. I think boomer McMansions, so to speak, and condos probably run into problems in certain areas in terms of being oversupplied relative to the next marginal bid from their kids. Uh, I think certain areas that are starting to kind of come off the lows are probably going to keep doing so. By me is a perfect example. Cleveland did nothing for like 20 years. And then like this last 4 years, it's up like 60%. Some of it is just a quality of living, right? Low cost of high quality education, lower cost of insurance, a good place to raise a family, and across sort of the Midwest, second and third tier cities, I think probably do okay. But now you're still going to have probably some period of time where AI does drive unemployment. That's a problem, I think, for all housing. I agree. And I think particularly for the younger generation, like I think Bitcoin, forget about what I think. Empirically, Bitcoin has been demonetizing housing. It has. Look at the price of a house in Bitcoin. It's collapsing over the last 5 years. I think that's going to continue. And I think while the older generations look at that as Bitcoin is a bubble, I think the younger generations look at that as it's demonetizing of housing. Some part of the home prices we see is because people have bid it up as a store of wealth. And so to the extent we see things like Bitcoin being used as a store of wealth more by the younger generations than the older generations, which we absolutely are, then I think housing in Bitcoin terms is going to keep collapsing. And so long story short, I think you want to buy a house, buy it to live in, buy it to raise a family, and buy it because the school system's good. Don't buy it to make money though, because I think the days of the last 30, 40 years of where interest rates only go down and to the right and home prices only go up and to the right, that, the older generations caught a nice wave of, and good on them. I think those days are over. So that's how I would think about housing from here. I think it's a deeply individual, local, niche, personal decision. I don't think it's any more sort of just buy it all and hold it. From SA, tell me I'm nuts for not selling off some of my gold and silver positions. Well, I think it depends how big are you. Look, if you're 100% gold and silver, I might take some off the table. If you're not, if you're 20%, if you're 30%, then it becomes, why? What are you going to buy? Why don't just sell because price is up. Price and valuation is arbitrary, as one of my mentors in the business told me. So a long time ago, many times. What are you going to sell it for? Why? What are you watching that makes you want to sell gold for what? For dollars? The American government's printing money to buy commodities, and you want to sell gold to get the dollars they're printing to buy the commodities? Not what I want to do. But again, it depends on waiting. It depends on personal situation. It depends on, are you 5 years from retirement? If I was 5 years from retirement and I had a huge position, yeah, I'd probably take them off the table. So I don't like putting that kind of position on in the first place. So it's an intensely personal position, but I do think it's important around how big are you? Are you levered? Don't be levered. If you're levered and like wildly long, and yeah, take some off. If you're not levered, if you're not that big, if you're not that close to retirement, if you have something really interesting on the other side to buy, that it's very positive cash on lever returns, and yeah, sure. So I would just encourage people to know what you're doing, why you're doing it. That's all. And I think that's an individual decision for every person involved. And then finally here, B, do you expect U.S. equities to continue holding their own against the U.S. over the next few years, or was this year just an outlier? U.S. equities are 2/3 of global equity market cap, right? And we've seen that trumpeted as sort of, dominance of the dollar, dominance of U.S. equities. No other markets, no other economies, which are actually pretty big in some cases. The Japanese economy is pretty big. The European economy is pretty big. Chinese economy is, on a purchasing power basis, way bigger than ours. Their equity market caps are tiny compared to our equity market cap. And again, as I was just saying, don't just take action because of valuation. Take action when something changes. Well, what's changed? Well, in the last 6 months, the Trump administration has begun telling people, take your money and go home if you don't do what we tell you to do. Do you think Europeans, and I'm a German descent, I can imagine how the Germans will take being told, Koreans, Japanese, the Chinese, do you think they're going to sit there with 2/3 of the world's equity market cap sitting in American markets while the American administration's telling them do what we tell you or go home. I think what we've watched in markets empirically this year of this other ex-U.S. equities keeping up with U.S. equities has been foreigners going, okay, fine, we'll take some of our money, we'll go home. And with the American government continuing this strategy, I don't see why that would change. What if they take another what if they take 5 to 10% of their money home each of the next several years? Well, our market's huge. Their markets are tiny. To me, it suggests that their markets probably hold up pretty well relative to the U.S. For the next couple of years, and certainly at least as long as the U.S. government's telling them to, rage against the machine foreign policy. Do what we tell you. Do what we tell you, or take your money to go home. So, with that, I am going to finish up for the day. Thank you, as always, for joining me. If you like these updates, check out FFTT-LLC.com for more information about our tree rings product. 10 most interesting things, brief synopsis on what grabbed our attention about each of them, and whether it is changing or reinforcing a way we had previously been thinking about the world. So everybody have a great rest of your week, and we will talk with you soon. Take care, everyone.